Okay, just a quick sound check. Can everyone hear me? Okay, perfect. Sorry about that. Okay, happy Friday and good morning to everyone. My name is Tony Zhang. I'm the Chief Strategist here as OptionsPlay. Welcome back to our Friday morning market outlook session. We have a lot to cover with you here today because there's quite a bit that's currently happening in the markets. We're certainly still at a bit of a battleground state, so I want to update you on some of those stats here today. Let's first start off just saying that what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's first start off by the broader market, the S&P 500. We are back at that 284, 285 battleground level that we've been talking about since April. April 9th was the day that we basically entered this trading zone between 280, 290. We can give a little bit of room to the downside, but we've recovered quite a bit, but we're still below that 20-week moving average. We've really struggled to get above that 20-week moving average. The daily chart has really struggled around this 285 area for a month and a half now. Yesterday was really the first day that we saw a bit of weakness in the markets early in the morning, but came back roaring back as soon as we hit around 10:30 in the morning, and ended up being positive on the day. Today we're opening up just about 1% lower, still near the bottom of that 20-week moving average, 20-day moving average, somewhere around there. So we're still holding this 285 level and we're battling it out. And one of the things that I want to point out is really just around the bifurcation we're seeing in this market, why we're seeing this kind of back and forth around this 285 level, and really comes down to the overall market, the different sectors, which today we're going to break down all the different sectors and show you sectors from the strongest down to the weakest in the particular order, so that you can see why we're seeing this type of battleground in the current markets. Technology obviously being the primary driver here of this market moving higher. We've had this is basically 5 waves of the technology sector moving higher, continues to make higher highs, higher lows. Still, the moving average line looks slightly pretty positive right now in terms of technology. So one of the strongest sectors right now, actually the strongest sector right now for us to take a look at. But on the flip side, you have plenty of sectors that are very weak, including small caps, really haven't even made it back to the December 2018 lows, still trading below those 2018 lows. So small caps looking very weak, trading below the 20-day moving average, managed just to get back towards the 20-day moving average, but likely is going to start to roll over here. So we see this bifurcation, which is something we've been talking about for quite a few weeks now across the whole sector. I will say, we talked about hedging your portfolio in our education event last Thursday. And I said that I think you need to be patient. I don't think it's time to pull the trigger on that yet. Yesterday was the first time that we really saw some indication of some weakness in the markets. I actually myself put on a put spread early yesterday morning at about 9:30, right around the open, because we were opening below the 20-day moving average. The VIX went into backwardation again at the open. So I put on a small put spread on SPY. And by 10:30, 10:45, the market had completely turned around. VIX went back into contango. We were back above the 20-day moving average, and I closed out that small hedge that I tried to put on. But that was the first time in weeks that I started to really think about putting on a hedge for the overall market. But again, didn't work out. So we're back in this kind of buy the dip type of environment right now, where we're just fluttering between risk on, risk off. We're just on the edge, and we're battling it out around 285. And that's the market that we're currently in. And I don't know how many people here on this call may have thought about buying some puts, or maybe bought some puts yesterday around the open, because you saw the markets were starting to turn around. You saw a little bit of momentum to the downside. If you did buy some puts and perhaps you're still holding on to it, please type 1 into the chat window yesterday morning, because I think a lot of people got caught out yesterday morning trying to buy some puts, thinking that the markets were going to get a little weaker. I certainly did, but markets turned around and we're back into this kind of twilight zone. And this is something that we've been talking about for quite some time, is that despite markets looking very top heavy, despite valuations being fairly stretched right now, we continue to make higher highs. But as we do that, momentum actually continues to not make higher highs and actually starting to slow down. But as we pointed out, we had the same thing back between November and January, where every single time we made a new high, we basically said this doesn't quite make a lot of sense. Corporate profits aren't really growing. We've had this long rally without any real checkbacks, and we saw the same thing. Momentum continued to decline. And on each subsequent rally. And basically what we're seeing is that this type of environment can go on for quite some time. In the time of November to February, that was 3 months time of this continuous deja vu that we're currently in. And the other thing I want to point out is something that we've been talking about buying hedges and thinking about shorting the market, is really that you need some type of catalyst for that to happen. And I simply don't see that just right now. Coronavirus was the big catalyst for that February sell-off, but right now we don't really have any true catalyst, because all the bad news that we see in the news every single day, we already know that that's happening. We know about the economic devastation. We know about the unemployment. We know about the changes in jobs. That stuff is known. We know GDP is going to be terrible. We know corporate profits are going to be terrible. So this news that comes out every single day is not really a surprise to us, and I think that's why the markets haven't really moved, which is why, again, I highly encourage at this current moment, until we start to see some momentum shift to the downside, which we got a peak of that early yesterday morning, but it didn't last, and that's kind of what we're expecting to see out of the markets these days, is that you want to continue to sell premium. We're going to show you some of those trades here today. Okay, so that's the current market environment, and I know many of you are saying to yourself, the market continuing to move higher doesn't make a lot of sense. Unfortunately, it doesn't always have to make sense for the markets to continue to move higher. And keep in mind that typically before a type of market crash or a market correction, markets usually reach a bit of euphoria. And I don't think we're quite near that euphoric stage, maybe on certain names and certain sectors, but I would say it's fairly limited to a certain few names that have this kind of euphoric feel to it. But the markets overall haven't quite reached that kind of euphoria stage. And usually you need to see that some of that before you really get that major sell-off. I will say that, for markets to reach that euphoric stage, we don't necessarily have to make new all-time highs, because we are trading at substantially higher valuations, because even though prices come down, valuations in terms of corporate profits and revenues have come down even further. So even though we're trading here, even as the prices stay relatively flat over the last month, corporate profits have declined over that month. So even though we haven't progressed in price, we have certainly progressed in valuation. So keep that in mind when you're thinking about the markets. But today what we're going to do is we're going to look at a few different names, a few different sectors, and kind of give you a better understanding as to how we're viewing the market. So first and foremost, the battleground is due to the bifurcation that we see in the markets. We have a few sectors that are going higher, a few sectors that are moving lower. So that's really tugging the markets back and forth around this 285 level. And we're opening up just a few points below that 285 level. But again, still in this equilibrium state at the moment. And the question that I get probably the most right now is that, are we at a market top? Is it time to start buying puts? We talked about buying puts and what the strategy is around that last Thursday on our education event. But as I said that, at the moment, we don't have a catalyst to be buying puts just yet. We want to be prepared. You might want to step into, be ready to pull the trigger on some of those trades each morning when the market opens. If the market starts to open weaker, be prepared for it. But at the moment, still continue to collect premium, because it's going to be expensive to buy those puts. You're going to need the premium that you collect now to buy those puts. So we want to think about looking at, how do we measure euphoria in the particular markets? Right now, we don't see that. We don't see a lot of stocks that are really overbought. We don't see a lot of stocks that are above its 20-day moving average. You need those types of stats in order for the markets to reach that euphoric stage, and we're not quite there yet. Some of the things that we've been talking about quite a bit is that VIX is still in contango, meaning it's still in this risk-on environment. Like I said yesterday morning when we opened, VIX went back into backwardation, which is why I put on a small put spread on SPY, but it went straight back into contango. We're opening up just shy of going into backwardation. Front month VIX is 34.8. 3-month VIX at 34.9. So we're basically at even. These two are, once the front month VIX gets above the 3-month VIX, that's a risk off indicator. But again, we typically see this around that one level multiple times. It doesn't quite, but you need a real push below that 3-month. You need the VIX to be significantly above the 3-month VIX for us to be back in this risk off environment. But that is something that we're keeping an eye on right now, and you should too in your trading. Oil continues to be relatively stable. Actually, crude is back up to about 25, or WTI is back around 25. So that type of stability adds onto our risk on environment. High yield still remains relatively stable. We have an HYG trade on right now. It's still staying above that $78 support level. If we break below 78, that would be my indication to cut the trade on HYG from last week, but we're watching that very carefully. HYG is still at this point holding that $78 support level. Liquidity, 165 liquid option symbols, very much in line with what we've seen over the last few weeks. On the high end, about 180, and the low end around 160. So this is still fairly normal and contained at the moment. We're not seeing any evaporation in liquidity. Usually, if things start to get a little worse, we will see that number decline down into that 120, 100 level as things start to get a little worse, but we are not seeing that. So today, what we're going to do is we're going to go through all the sectors. We're going to show you all the sectors from strongest to weakest in order so that you can see what I'm seeing in terms of the sector rotation from sector to sector. And then we'll talk a little bit about winners and losers going forward, because as a result of all of this, there are a few industries that are going to be severely impacted as a result of longer term views that we are now saying, when we first started doing these types of research, we were talking about most of the research we're looking at late Q2, early Q3, things getting back to normal. I think we all realize that that is not going to happen, that is likely going to be Q4, Q1 for a lot of industries, if not significantly longer for other ones like travel. So we're going to talk a little bit about some of the trends that we see and how we think we want to position for that particular market. So we'll start off by looking at the sectors. So I'm going to start off again going from strongest to weakest. So technology is number one. Technology, the 20-day moving average remains incredibly strong. It's still a pretty straight upward trajectory. Every time it touches the 20-day moving average, it bounces higher. It's done that multiple times. It's back at the 20-week moving average. Right now, we're trying to see if this is going to continue that upward trajectory. It's above its 20-week moving average as well. Money flow is pretty weak here, I will say. That is concerning for me for continuations, but this is the type of this is some of the euphoria that I'm starting to say that we need to see before a market top. But it certainly looks like that. Momentum is not declining as much as some of the other ones, so it's still confirming these highs. So that's why technology remains the strongest sector. And likely this is really where we are going to see corporate profits remain relatively stable as a result of coronavirus, because there are some companies that actually will benefit from us working from home and shifting our whole consumer spending behaviors going after COVID-19. So technology at this point remains incredibly strong. The second sector that I want to take a look at is actually communications. This is actually a bit of a surprise. It kind of came out of left field a little bit, but communications also remains incredibly strong. The chart looks very similar to technology. Every time it touches the 20-day moving average, bounces higher. We just touched the 20-day moving average yesterday. Same thing here as far as momentum. Momentum actually continue to confirm the higher highs and higher lows. So we're not seeing the same type of exhaustion that we typically see with some of these, as we've seen with the overall market as they made higher highs. We weren't making higher highs on momentum, but both technology and communication continue to do that. That's why these are the strongest sectors. Still staying above its 20-week moving average, but again, money flow remaining fairly weak here, which is concerning. But as we can see, money flow many times can remain weak for quite some time before we do get that pullback. I will say that the longer this type of stretch valuation continues to go on, the longer these sectors continue to move higher, the higher the likelihood that you have a more violent crash here. So those are things that we're currently watching, but at this point we don't quite have that trigger yet. Healthcare is something that's been very strong after COVID-19, but over the last few weeks have really started to rotate a little out, which certainly has been losing its relative performance. As technology and communications continue to make higher highs and higher lows, healthcare has really been flat for the last month. So we're really starting to see rotation out of healthcare into communications, into technology. As you can see, momentum is actually not confirming these highs. Actually, as the market is moving sideways for healthcare, the momentum is actually declining. Money flow is not as weak here, so I do think that this is a little bit more supportive. You might actually see a continuation higher here in healthcare, still above its 20-week moving average as well. I think just from a fundamental perspective, healthcare has a better reason to be trading at a substantially better place than most other sectors, because healthcare, generally speaking, is either a net neutral or beneficiary as a result of coronavirus. So there are, in my opinion, some fundamental reasons as to why healthcare remains relatively strong here at the moment. Now we look at consumer discretionary, which also is a bit of a surprise that it is as strong as it is, because of the fact that this is the segment of the market that we believe is going to be most impacted. But over the last few weeks, it really has started to move sideways. So we're starting to see some rotation out of consumer discretionary. Momentum is continuing to move lower. Money flow is very weak, and it's just sitting above its 20-week moving average. If we break below that 20-week moving average and we get below that 20-day moving average, that certainly puts us in a much different scenario for consumer discretionary. But keep in mind that Amazon and Home Depot are a third of this particular index. So they are part of the reason why consumer discretionary on the surface looks very strong. But if we look at some of the individual names within consumer discretionary, the vast majority of names are very, very weak, with the exception of really Amazon, Home Depot, Starbucks, McDonald's, those types of names that have been holding up this particular sector. But this is one that we're keeping an eye out, because we do think that this could shift lower quickly. Next, we want to look at staples. Staples, very similar to consumer discretionary. Really, the two chart looks almost identical here. Basically, staples was very strong during the initial rebound, but over the last month have really started to move sideways. So rotation out of staples. As you can see, momentum also moving lower as we kind of started to move sideways, signs of exhaustion, sitting just above its 20-week moving average. So also staples on the verge of potentially moving lower, but at the moment, we're still cautiously bullish here on staples. I think there are still plenty of names within the staples, especially food staples, that will probably do well. So trading staples here, I would prefer to be in some of the stronger food staples names. So especially if we anticipate that people are not going to be comfortable going out there getting into restaurants just yet, that they're going to probably cook from home for quite some time. Food staples, even some of the more speculative names like Beyond Meat, those are the types of names that I think are worthwhile looking into within the staples name here. Utilities is actually one. So now we're starting to get into the weaker sectors, right? So we started out with the healthcare, with technology and communications, the strong ones, the ones that are sort of on the verge of potentially going either way, staples and discretionary, and utilities is where we start looking at some of the weaker names. Utilities trading below its 20-day moving average, 20-week moving average as well, both the 20-week and the 20-day moving average sloping down. Utilities managing to get just near the 20-day moving average yesterday. So we anticipate that utilities will continue to be weak. One of the things that I will say that is a little surprising is that, given the fact that markets haven't moved a whole lot, treasury yields are virtually zero, that utilities haven't, I'm surprised that utilities hasn't seen more of a, I would say, flow into it, given the fact that it's one of the few sectors that pays a more stable dividend, especially during coronavirus. We don't expect utility company dividends to be impacted significantly, unlike energy companies. So I'm a little surprised to see utilities being so weak. Perhaps this is where we could see some rotation back into utilities as things start to stabilize. Hard to say right now, but certainly one of the weaker sectors right now. Utilities, I will say, the only thing going for it is that it's sitting above its 200-week moving average. Money flow is not particularly strong, but not particularly weak. So at the moment, as long as it holds 54, I don't think it's time to go short anything like utilities. But again, I'm always weary of shorting something at the moment that seems fairly stable, especially with one of the few sectors that pays a strong dividend. Materials also just hanging on by a thread right now, because it's continues to trade below its 20-week moving average, even though that moving average is flattening out. The sector itself predominantly has been moving sideways, but it is now below the 20-day moving average, and momentum is continuing to move lower. So the fact that it broke below, coming back to retest that 20-day moving average, chances are you have a more likelihood of a pullback down to the 46 level. So materials certainly one of the weaker sectors, and it makes sense. Materials, chemicals, basically the building blocks of a recovering economy. I think it's pretty obvious as to why this sector currently is looking relatively weak. A lot of the names in this particular sector, not particularly strong outlooks, especially given what we're expecting in Q3, Q4 of this particular year. Real estate, also not a huge surprise that this is a weak sector. Real estate, unlike the other sectors that have basically been either trading sideways or slightly higher, is actually making lower highs, lower lows, and starting to actually break down below some support levels. Momentum has actually continued to move lower throughout the whole time, confirming these lower lows and lower highs. The weekly chart looks very weak, well below the 200-week moving average, below the 20-week moving average. So it's sitting just near these $30 support levels, which go back to September and December of 2019. If they break below that, I certainly think that you can have some significant moves to the downside. Again, real estate being a weak sector, not a huge surprise, I think, for most people. Industrials also, I don't think particularly surprising. I think the first big thing I want to point out in industrials is that on a weekly chart, trading below the December 2018 lows, that's not a great level to be trading at. It's below the 200-week moving average, below the 20-week moving average. Money flow is extremely weak. And if we look at this, same thing, basically same chart, sideways market with momentum continuing to move a little lower, perhaps a little stronger than the real estate from a chart perspective, but money flow looks substantially weaker than the real estate chart, which is why I put this as a weaker, and it's well below that 20-day moving average. So I think you have a higher probability of industrials continuing to move lower. Similar type setup that we've been looking at from a financials perspective. If you're going to press any shorts, you want to continue to look at these very, very weak sectors for short opportunities. You don't necessarily want to look for short opportunities in some of the stronger sectors. Lastly, energy. Energy is still one of the weakest sectors, simply because it's trading well below its December 2018 lows. It's still below the 20-week moving average. It's trying to continue to make higher highs and higher lows. This is the chart that Carter and Mike looked at last week. Looking at this chart last week, it did look like it was going to have a nice momentum play up until 42. I don't know, with crude stabilizing around 25, I don't really see a catalyst for this to jump significantly higher, especially if you look at the fundamentals of these companies. You have $290 billion in downgrades in energy alone, which is a third of all downgrades across the entire market. And energy only makes up about 4% in terms of market cap, but they account for a third of all downgrades. So fundamentally, this sector, I don't think is looking particularly strong. And especially if you look at energy that, on the surface pays 7% dividends, most of those dividends are subject to major cuts over the next couple of months. So I think that that's a risky sector to be in if you're thinking about utilizing it for some income or for dividends. I think financials provide you a much more stable dividend, even though it's a lower dividend yield. But utilities and financials, if you're looking for yield, I think is a much better place, including even high yield, especially if high yield is managed to stay above that $78 level that we've been looking at for high yield. So those are the sectors, right? And that's why this is the rotation that we're currently seeing across the different sectors. What sectors are strong, what sectors are weak. So if you're looking for opportunities, and again, in this particular market environment, I'm going to show you a few examples of how I'm doing it, but you generally want to be selling options, because VIX is still at 34, so that's almost triple what we were trading back in February. So it's a great environment for generating income. And then what type of income strategies make sense? If you have stock positions, selling cover calls, these are the great times to sell cover calls. We don't see a lot of market upside at the moment. Selling cover calls is a great strategy to generate some yield, because if you do feel that you need to buy some put spreads when markets start to accelerate to the downside, like we saw yesterday morning, you definitely want to be able to have some premium to be able to do so. Now is the time to sell premium. And what you want to do is you want to sell upside premium, meaning bullish premium on sectors that are really strong, on stocks that are really strong, and then you want to sell some bearish premium on stocks that are really weak. And I have a few examples here that I want to show you. So some of the examples that I had, well, actually financials is actually the weakest sector, simply because it's trading below some of the moving averages. It is barely making it back to the 20-day moving average. And I think you have a relatively high probability of this continuing to roll over, especially in some of the weaker names that we talked about on Tuesday, which is the insurance companies and many of the asset managers that rely predominantly on yields to be able to generate their income, such as Schwab, E-Trade, these types of names. These are the names that we were looking at as part of our daily play. But one of the things I want to point out is really the retail landscape. This is where we're going to see a huge shift in how things are going to look in the next few years. This is a survey by UBS as far as where they think they're going to see the largest declines in stores, office supplies being first, consumer electronics, sporting goods. So, what is going to be the net loss in this particular category? I think it's going to be fairly wide. The net beneficiary are really two main players here, which is predominantly Walmart and Amazon. So I want to take a look at is Amazon. As small businesses close, as even major businesses close that rely predominantly on physical stores, that business is going to have to shift somewhere, and likely Amazon and Walmart are going to be a net beneficiary. So, the way that we're looking at the coronavirus is that it's really accelerating a lot of the trends that we saw prior to the coronavirus and forcing it, forcing smaller stores to close, forcing industries to consolidate. This isn't particularly great for the market overall, isn't particularly great for consumers overall, but this is reality. And what we're looking at currently is Amazon has really been basing for quite some time here above that 2250 level. And we think that this is a consolidation range that it's currently in for a potential push higher. When will that make that move higher? How much higher will it move? Very hard to say, which is why the strategy that we generally want to use is selling premium. Now, you can use Walmart because if you feel that Amazon is a little too rich, you can't trade names that are this particular size, if you will. But you can use a very similar strategy on a stock like Walmart, which I think is very similar from a price action perspective, from a fundamental perspective. But something like this, where if the stock's trading at 2388, I'm selling the 2390 put and then buying a 2300 put against it. In this particular case, as long as Amazon stays above 2390, I'm going to collect roughly $3,700 in income, and I lose $5,270 if Amazon's below 2300. So basically, looking at the Amazon chart, I'm basically believing that it's going to be trading at least within this range, looking for a breakout to the upside, or at least near the upper end of this range by the end of July. And I'm betting that the stock won't go below 2300 by expiration. And if it goes below 2300, that's the max risk that I have. But this is the type of strategy that I'm deploying across my portfolio for names like we did one in Lowe's here today. Lowe's also one of the names that is a net beneficiary of our coronavirus, because Home Depot and Lowe's, we've seen an increase in consumer spending in those particular categories, similar to Amazon. So those are the names that we are taking these types of positions in. And we specifically are seeking credit spreads, which I'm going to be talking about next Thursday on our education event, as far as what are the optimal credit spreads. So this is just an example of a credit spread that I would sell in my own account for trading these types of bifurcated markets. Now, the next one I want to point out here is Uber. And I know Uber doesn't sound like the type of stock that you might want to trade at the moment, but I will say that I think, as consumers shift from going back to work and perhaps are concerned about whether or not they're ready to get back on a subway, you're likely going to see people take more Ubers. And that's why I think Uber is another stock that you might want to consider taking a look at. Now, I would, again, utilize a put credit spread here to try to take advantage of Uber staying sideways or potentially getting a little support to the upside by selling a put credit spread here, a June 26, 33.29, $4 wide credit spread collecting $1.50, a little more than a third of the width, which is really what I'm trying to collect here on the type of credit spread. And lastly, before, I know we just started here a few minutes late, and lastly, looking at the airlines and the travel stocks, a few weeks ago, I was looking at seeing that there's some stability here. It doesn't seem like that's really happening right now. Airline stocks seemingly have broken below this triangle. We've been talking about this triangle for quite some time, but looks like it's starting to break below. I'm more inclined to be looking at short opportunities in this particular industry. I don't see a huge catalyst for these stocks to rally at the moment. So I'm looking at, again, similar type strategy, but just on the bearish side. Just to give you an example, something like a June 26, 20 by 25 call vertical here, collecting $1.98, well above 1/3 of the width. With all of these credit spreads, you're trying to collect more than a third of the width, especially when volatility is this high. You should be able to collect closer to 40% of the width. That's the type of edge that you're going to get from the options market right now when volatility is relatively high. And this is really how you can use options to your advantage when markets are kind of shifting back and forth. There's not a whole lot of movement, collecting premium. And then if and when the market does make that shift to the downside and start moving to the downside, that's when we want to start buying puts. And we're looking at things like VIX backwardation, which at the moment still is not happening. SPY looks like it's opening up just around 282 right now. So we're still back, right around that battleground, around 284, 285. We haven't seen this shift to the downside just yet. It could happen tomorrow. It could happen today. It's hard to say. But at the moment, my inclination is still at the moment is to kind of sell premium on these dips. Sell put spreads on the dips, sell call spreads when they kind of reach a slightly overbought condition. But focus more on the specific sectors. If you're looking for bullish opportunities, focus on the strong sectors. If you're focused on the bearish opportunities, focus on the bearish sectors that we went over here today. So that's what I wanted to cover with you here today. Like I said, a lot to unpack, a lot of sectors on the move right now. So focus on those. And I hope that this was useful in helping you set up your trading day. So thank you so much. I hope you guys have a great trading day, and I'll see you guys next week.